Good morning to everyone. I'm calling in from snowy Ottawa, if you can believe it. My name is Mike Sind, and I head up the Costmine team, based all over, but predominantly Spokane, Washington, and Vancouver and Toronto. If you don't know Costmine, what we're really good at is great data collection in the sense of properties, equipment data, meaning CapEx and OpEx for equipment data, as well as labor data. So you'll see some of that showcased here today, but wrapped in a story about where we see cost inflation going. So thanks again for the opportunity. So starting off, just quickly showing off our property data. So we've put together some analysis here around, okay, it's one thing to search for properties around interesting grades or interesting reserves or resources, but it's another then once you start layering on risk. So using our property database, you can do a nice job of finding interesting properties that suit your appetite for location, size, grade, jurisdiction, stuff like that. We've partnered with a company called Maplecroft, and Maplecroft bring in that risk profile. So what we've done here is created a ranking of global copper projects, everywhere from advanced exploration through to pre-feasibility. And we've got about 300 copper projects globally. And you can kind of rank them here based on size. So the size of the bubble is the reserve value. So what's in the ground times the copper price. And then by size, just raw size, which is on the x-axis. But then if you start to think about the risk profile for properties, which is the y-axis, this is just a simple composite risk profile around all kinds of metrics that our partners at Maplecroft track. So things like economic regulation, indigenous land rights, metrics like biodiversity, et cetera. So when you pull together a composite, you start to add in a new layer of thinking when it comes to sifting through our property database. So there's some really interesting stuff here around that. And that's something that we like to talk about, is not just the technical aspects of your project or what you're screening for opportunities, but once you layer in the risk. So there's some nice stuff here. But moving on, I'm going to get into what our real strength here is at Costmine, which implies in our business name, which is industry costs. So one of the themes I'm going to talk about this morning is the trade-off between size of your project and then also the cost of it. And when I mean cost, I mean OpEx, I mean CapEx, and other technical and commercial attributes. So some of this stuff might not be new, but what I think we're bringing to this is hard numbers based on our research. So again, we're tracking in great detail equipment CapEx, OpEx, and labor costs, and putting them through our cost estimation software to come up with cost estimates. So not surprisingly, on the y-axis, you can see, the larger your throughput is. So the size of the circle indicates your ore throughput. The larger the size of your mine, the more expensive it's going to be to build, and also the more expensive it's going to be to operate. But that's not always the case. There's a point where a large mine starts to become so large that the diminishing returns of OpEx start to show through. And what I like to highlight on this chart is sort of down here in the lower left, where, for example, a 10,000 throughput per day mine, the OpEx of it starts to converge with a 5,000 throughput cost per day, a 5,000 ton throughput per day mine. And there start to become trade-offs here. And there's no one answer. It depends on your appetite for risk on cost, your appetite for risk on size, just your footprint of your asset. So there's a lot in here, and what we bring to this is hard numbers to start to demonstrate where that spot might be for your particular appetite, be it for cost or what have you. So there's some interesting stuff here. So again, not necessarily new, but putting hard numbers on the trade-offs that you're going to experience when you start to say, well, let's maybe start looking for smaller assets and developing smaller assets, or indeed brownfield, and what that might look like for costs. So I'll start with the CapEx item here. So digging into the CapEx side of the equation, on the left-hand chart is showing just the trends in cost inflation that we've been seeing. And this chart is largely US and Canadian oriented. It's not international. We do have an international audience that use our data, but this is really built for this audience, which is North American. So you can see here the trend in inflation over the past sort of 10 years. For the CapEx. So on this chart, we've held firm the 10,000 throughput. So that's the size of the mine. And then the various lines show your strip ratio. And so what you've seen is probably not unexpected. That is, the larger your mine, it's been beneficial from an inflation perspective, meaning it's been less harmed by inflation over the past 10 or 12 years. So that's pretty interesting. And I'll get into a few more reasons why we think that is. But the larger your mine, inflation hasn't touched you as much. You're probably buying bigger trucks that have been less touched by inflation, and I've got a chart on that, and different reasons. On the chart on the right, it kind of tells the same story. So if we hold the strip ratio constant, so we stick with a 4:1 strip ratio mine and start to play around with the throughput, it's kind of the same story. So the larger mines, so here it's the purple and the red lines, 20,000, 40,000 per day throughputs, they've also been less harmed by inflation over the past 10 or 12 years, which is an interesting trend. But it's still very expensive. If you think back to the last chart, a 10,000 throughput mine could be 2 to 3 times the cost of a 5,000 per day throughput mine. So you're still spending a lot of money. And yes, it is less touched by inflation, but it's still an expensive asset to build. On the OpEx side, I really like the chart on the left here. So what this is showing is just those diminishing returns from an OpEx perspective. So here we're holding a 4:1 surface mine strip ratio constant. And on the x-axis, you can see the sizes. And you can see here, once you get to 5,000, 10,000 per day throughputs, the OpEx benefits start to diminish. And so that, again, it's down to your appetite for cost and risk when it comes to building these larger assets. Not to say that they're not good, but you want to start thinking about, okay, well, I need more shifts, I need more infrastructure, I need bigger roads, I need all these things that bring with it more cost risk. And are you set up and ready to take on those risks as your mine gets bigger? And the chart on the right shows the same. So here what we're doing on the x-axis is just changing up the strip ratio, so more ore throughput or more waste. And then the lines are just the different sizes of mines. And you can again see those larger mines, whether it's a 40,000, 20,000, 10,000, around higher strip ratios, they start to converge on OpEx. And so again, it's another way of thinking about, okay, is bigger better? And what am I taking on here if I build a bigger mine, one that's processing more waste or different things around that nature? So it starts to sort of just highlight those things you want to think about when you're starting to look at bigger opportunities. Now, digging into some of the costs, and this is really where we're good. So we have a team in Spokane of engineers and geologists, and we talk to OEMs around the world, mostly in North America, but we can flex a lot of these costs for international mines. And we're collecting hundreds and thousands of different pieces of equipment from a CapEx perspective, and then using our models to work out the OpEx on a cost per hour basis to operate a piece of equipment. So the chart on the left is CapEx, so buying pieces of equipment, and you can see if I'm building this is a relatively generic mine, a 10,000 throughput, 4:1 strip ratio surface mine. To build that asset, you're looking, 60% of those costs. If it's a $50 million mine, it's 60% of those costs are going to be rolling stock. So your dozers, your haul trucks, etc., diggers, and you can see the rest of the items there on that pie chart. So just kind of putting hard numbers on what we intuitively probably know, but hard numbers nonetheless. The right-hand chart is something I think actually raised a few eyebrows. Sometimes people underestimate the cost of labor, especially in recent times. So we think about operating that 4:1, 10,000 ton per day mine, about 40% of your costs are going to be labor. And that probably has some upside risk to it based on some of the newest numbers we've got. So the chart on the right, I find interesting, not just because of the labor, but because of the other big chunk on the whole right-hand side of that pie chart. What is that? It's hydrocarbons. So anything related to the price of oil. So fuel and lubricant, tires, diesel, even electricity, perhaps for remote mines. It's a really simple story in many senses. It's an OpEx story is consisting of largely labor and hydrocarbons. And if you're controlling those, you're probably doing a good job. So some interesting stuff there. And a lot of this stuff is based on our models and analysis that we do here at Costmine. Now digging in a little bit more, and just to finish up the equipment story, again, we track hundreds and thousands of pieces of equipment, different types, classes, sizes, drive trains, etc. So the interesting story here on the left is, I think, that haul truck. So quite not homogeneous, but a fungible sort of piece of equipment, a 100-ton haul truck. It's off an assembly line. It's probably automated in many senses to build. And inflation has more or less left that truck alone compared to some of the other items. And the story here is homogeneous or fungible type pieces of equipment versus more bespoke. So if you're starting to have to get into bespoke conveyors or pumps or things like that, that's when the inflation starts to set in. Your equipment maker's probably incurring higher labor costs to make something more tailored for your asset or for your needs. Whereas for the haul truck, it's quite an automated type piece of equipment. So that's an interesting story that jumped off the page at me, is how inflation has mostly left these bigger pieces of equipment alone. And there's definitely going to be exceptions to that for sure, but that's the high level story. And then the chart on the right is just the OPEX story, and that comes back to our hydrocarbons and our labor story. So operating these pieces of equipment, inflation has been quite quite nasty to, especially since sort of 2021 time, as the price of oil went from $30, $40 up to $80, $90, where we're at today. So operating these pieces has been pretty nasty. A lot of the stuff baked into the chart on the right too doesn't include some labor costs, which I'm going to get into next. We'll talk about labor next. You can see it stops at 2022. So up until I pulled this out of this chart. What this chart is effectively showing, we survey mines around the US and Canada. We survey about 150 mines in the US and about 75 mines in Canada. So we've got good relationships with a lot of mines around the continent. And so we collect very detailed wage and salary data from mines, actual HR managers at mines who we enjoy good relationships with. So what I've done for this chart is pull together a category of skilled wage. So that would include electricians, welders, plumbers, etc., things like that, skilled mechanics. And that's a broad category. And when I pulled this chart together, I expected to see something pretty different, to be honest. I thought we'd start to see that inflation story kick off around 2020, 2021. But what you can see here is we started to see wage inflation start to flare up even before the pandemic, which I found really interesting. And since 2018, 2019, we've seen wage inflation up around 6%, whereas before that, it was more like 2%. So that labor story is really starting to bite into that whole OPEX story, which is one to look out for. And we're going to dig into that just as we wrap up the presentation here, a little bit more on labor. So if I dig into, that was a broad skilled labor category. If I dig into a few more different categories around labor, you can see in the chart on the left here, just that pre-run-up, pre-2019, we saw wage inflation around 2-3%, and that was sort of a pretty steady rate that we saw through the years. There's obviously going to always be exceptions, but that 2-3% was a pretty standard, predictable number. But as we got into the later years, just pre-pandemic, our surveys were telling us, actually, things are starting to get kind of spicy. And we started to get numbers in the range of 2 to 6.5%. In fact, if you look into the numbers pretty closer, it's really more at that upper end of the range, more around the 6.5%, which is pretty predominant in a lot of these different categories. So I'm showing 4 different job categories here. We tracked about 25 different job categories in our surveys. And so if you dig into that, the predominance is around that 5-6% wage inflation over the past few years. And then the same is the case over on mine salaries. So salaried mine labor here. And you're starting to see, up towards 6-7% on some of the salaried workers. And these wages, all the charts have been showing, all of these wages and salaries are baked into those mine cost estimates. We incorporate all those equipment, CapEx and OpEx costs, including labor, hydrocarbons, etc. That's all baked into those numbers. So these last couple of charts are just showing some of the detail that we can bring to this. This is a US chart. We can produce this chart for Canada as well. So some good data, and that includes everything from oil sands to coal to iron ore to underground gold mines, etc. So it's a pretty broad representation of the labor scene. So that was a quick whip around. My name is Mike Sinden. I head up the Costmine Intelligence. Lee, I really appreciate the opportunity to speak here. It's a bit of a whistle-stop tour of what we've got to talk about, but if you want to know more, please feel free to get in touch.